Thank you very much to the CCF for the opportunity to present this morning. I have to be honest with you all and say that whilst I've given many presentations over my years, I have not done a Zoom presentation yet. So I'm hoping the technology works and also that we manage to get some good engagement and some good information as we go through. My details are at the back of the presentation, however, so if you'd prefer to reach out for a more one-on-one personal discussion at the end, I'm happy to do that as well. So I'm just going to share my screen and get straight into the presentation. So the topic that was given to us for this morning's presentation is managing the cost of workers' compensation insurance. And this is a massive topic and certainly one that has been front of mind for employers and insurance brokers for many, many years. If we start by going back to basics in regards to workers' comp. So firstly, workers' compensation is without a doubt one of the largest costs that is incurred by many businesses. So particularly if you're looking at a predominantly labour supply type business, you know that your costs will start with wages and then often workers' compensation is second or third on that list. It's compulsory, so it's a statutory class of cover, which means that the cost is unavoidable, regardless of whether you see value in it or not. It is compulsory. The West Australian workers' compensation system, and in fact across Australia, the schemes are no-fault schemes, which means as an employer, you're paying those costs regardless of fault. Your employees can be as absolutely ridiculous as they like. They can stick their arm under a guillotine and lose their arm. You're still up for those costs, or the scheme is still up for those costs, and ultimately yourself is still up for those costs. The premium rates in Western Australia are variable, as Western Australia is an underwritten state as opposed to a managed fund state. And I'll talk a little bit more about that throughout the presentation. And the scheme as a holistic scheme is regulated by WorkCover, with policy and claims management provided by licensed insurers. So not every insurer in Western Australia can provide workers' compensation cover. They must have a license to do so. So if you're one of those insurers, and there's 5 of them, what is your objective? Because it's an underwritten state, what that means is the insurer is taking the risk. So when they collect premium, they have to collect enough premium across their entire portfolio to pay for the costs of the claims, their expenses. So, obviously they have their own staff, operating costs, work cover levies, reinsurance costs, etc., that they have to meet. And they also have to generate a profit or a return on equity to their shareholders. So ultimately, they're a commercial business as well. And the difference between an underwritten scheme and a managed fund scheme is a managed fund scheme is government-backed. Underwritten is privately underwritten by insurers. So how do they set the premiums then? So, if they're assuming they have to collect enough in premium to cover all of those costs, how do they set them? At a very basic level, they collect information from each employer. So the information that they collect is firstly the wage estimate and the business activities. Very important to get the business activities correctly noted, because based on that, the insurer will allocate an ANZIC code to your business. Once the ANZIC code is identified, the insurer will determine what Gazette rate is applicable for that ANZIC code. And in very simple terms, the premium is then the wages that you've estimated by the Gazette rate that is applicable for your business industry ANZIC code. With an underwritten scheme, the Gazette rates can then be loaded or discounted. And the policy itself is adjusted annually based on declaration of actual wages paid. So whilst you provide an estimate at the beginning of your policy period, you're required after the expiry of each policy period to provide a statutory declaration of your actual wages paid. Premium can go up if you've paid more in wages than you estimated, or down if you've paid less in wages than what you estimated. So assuming that we start with the Gazette rate, how are the Gazette rates set? So what factors affect those? So your Gazette rates are set annually by the scheme actuary. So the scheme actuary in Western Australia is PricewaterhouseCoopers and has been forever. I won't bore you with what an actuary does, except to say I wouldn't want to be one. They spend their life looking at very, very large spreadsheets and trying to project the future. With regard to the Gazette rates, they are updated and re-released once a year, and they're effective from the 30th of June every year. So for 2021 to 2022, the Gazette rates have already been released for this year, and the recommended increase across the entire scheme is 4%. So that increase has been based on a few different factors, but effectively what PricewaterhouseCoopers have determined is that the current overall premium pool that's being collected by insurers is not quite adequate. So 4% is not a dramatic increase, but it is an increase. So it's not quite enough to cover the costs, particularly with any kind of escalation that they're predicting for the coming 12 months. And as such, there's an overall increase recommended of 4%. Bear in mind that with that 4%, each individual ANZIC classification will have been assessed, and it will either have gone up or down. So the most significant increase that's coming through for an ANZIC classification is around 12%, and some ANZIC classifications have gone down. If anyone is interested in looking at that in further detail, the full PricewaterhouseCoopers report is actually available on the WorkCover WA website. Some nice light bedtime reading. So where does the scheme actuary decide, or where do they get their information from in order to determine what the Gazette rates should be? Every licensed insurer has to submit reports to WorkCover on both a monthly, quarterly and annual basis. And in that data is consolidated claims and policy data. So they will have by individual ANZIC code, by individual policy year, declared what wages have been used, what claims have been incurred, what costs are being paid, etc. And out of that information or that data pool, PwC analyse that, project what the future might look like, so identify any trends, etc., project what the future might look like, and then set the coming year's rates. When we then go down to a more granular level and start thinking about individual businesses, what influences individual loadings or discounts for employers? So the sort of factors that influence that are the actual makeup of the workforce. So for example, some businesses might be in industry ABC. So let's use agribusiness as an example. And in some instances, that will mean that every one of their employees is doing cattle station type work. They're out and about in paddock. They're doing high risk activities. But in other instances, so corporate agribusiness, for example, they may have some staff that are white collar, so they're purely office-based staff. So when we're collecting information from clients in order to present a risk to insurers, we'll ask questions like, what is the actual makeup of your workforce? So, your industry is X, but what does your actual staff or workforce do? What percentage is doing blue collar versus white collar type work? The next area that insurers look at is the safety management systems that are deployed by various businesses. So prevention. Now, if we can stop an injury occurring, that's far, far better than managing an injury when it happens. Sorry, my phone is going off over here. Sorry. So insurers will also look at, what are your safety management systems? What do you do and what have you implemented in order to prevent injuries occurring in the first instance? The other two factors are things such as the size of the business and the claims experience of the business. And I'll talk a little bit more about both of those. When we talk about claims experience, being a factor that insurers look at, claims costs make up around about 75% of the total insurance costs that must be met out of the premiums. So if we go back to my earlier slide where we talk about what do insurers have to pay out of the premium that they collect. So they have to pay the claims cost, they have to pay their own expenses, and they have to generate a profit. So claims costs is by far the most significant of those three expenses that need to be met. So out of every dollar that they collect, about 75 cents of that is paid out in claims. It therefore stands to reason that the ability to reduce or control those costs leads to a better outcome for both the insured and the insurer. So what makes up claims costs? We're talking about, people injuring themselves here. Out of every dollar that is paid in a claim, where does that money go? So in weekly benefits, so wage costs, about 45% of claims costs are made up by weekly benefits. Medical/hospital is only about 14%. All other treatment, so in all other treatment, we're talking about physiotherapy and those types of things there, about 5%. Vocational rehabilitation, so getting someone back to an alternative duty, is about 4%. And then settlements, so common law costs, redemptions, Schedule 2, which are permanent impairment costs, and legal costs make up about 33%. In numbers wise, that bottom category of payments, so your common law redemptions, second schedule and legal costs, is very, very small. So you have a very small number of claims that fall into that category, but when they get there, they're going to cost a lot of money. Things like your weekly benefits affect a far more significant number of claims. So how do you control your claims cost? The very first trick to this, or challenge to this, whichever way you choose to look at it, is to reduce the duration of all of your claims, therefore reduce your weekly payments, therefore reduce your ultimate claims costs. Sounds very simple, doesn't it? How do you do that? So in reality, someone injures themselves, they contact their supervisor, I've injured myself, I need some medical treatment. They go off to their own doctor. The doctor says, oh, yep, you're injured, and they give them a week off work. So they sign them off for the next week. And during that week, you're paying, or the insurer is paying for their wages. So the way to reduce duration and therefore weekly payments, or one of the ways to reduce duration and therefore weekly payments, is to provide alternative duties. What that means is, whilst someone might not be fit for their full pre-injury duties, they may well be fit for alternative duties or light duties. And these might include a myriad of different things. In some instances, it's doing some of that office-based work that nobody has time to get to. And in other instances, it's actually 40, 50, 60% of their pre-injury duties, with just some restrictions around certain aspects of that. So it might be a limit on how long they're able to be seated for, or the weight that they're allowed to lift, those types of things. But being involved and engaged with the medical decision or medical sign-off at the very early stages of the claim will assist in ensuring that people aren't signed off fully unnecessarily. The second way that you can reduce duration is appropriate medical intervention right from the start. So again, injury occurs, employee comes to their supervisor, I'm injured. Instead of sending them off to their own GP who has no knowledge of the business or the role that's required and will therefore err on the side of caution and potentially sign people off that don't need to be signed off, directing the initial medical assessment to an occupational physician who has experience in the workers' compensation space, or even just a GP that has knowledge of your business can really assist in this regard. So they understand that you're able to provide light duties or alternative duties, and there is, in fact, some capacity for this individual to come back to meaningful work despite the injury. The other area of appropriate medical intervention is twofold. Firstly, priority appointments. So if you need to get people into a specialist, you can wait a very long time. And I'm sure anyone who's had any kind of medical issues themselves or a family member has had will agree with this. Sometimes you have to wait a very long time for an appointment. So having priority appointments is important. And then also early diagnosis. So if someone's got an injury, what is that injury? What is the prognosis? What is the right treatment? And how long should this take for this person to fully recover? And then measuring the progression or trajectory of that injury against that diagnosis. We've had scenarios where people are injured. It's quite clear they have an injury, but nobody knows what that injury is. So it can sometimes take a number of different disciplines and specialists and appointments to, in fact, find out what is wrong with someone. But the sooner you're able to do that, the sooner you're able to implement appropriate treatment, the sooner they're going to recover and be able to return to work. The other sorts of things that you can do is look at minimising the risk of re-injury. So again, that's why things like appropriate restrictions are put in place. Someone's, yes, you're fit to return to work, but you've got restrictions. Those restrictions should be monitored and adhered to so that that individual doesn't re-injure themselves. But this also goes back into prevention. So this is also about thinking, how did that injury occur? Is there anything that we could have done differently, changed, tweaked, amended, so that this doesn't happen again to someone else in the future? We talk a little bit here about maintenance versus treatment. With the workers' compensation system, it's about treating the original injury. It's not about saying Fred needs to now have a hydrotherapy session once a month for the rest of his career. So that becomes a maintenance type thing. That's just about your general health and well-being. So it's about understanding when someone has recovered from their workplace injury and is now ready to just be, have their claim closed off and then deal with the ongoing maintenance of their general health and well-being themselves, as opposed to as part of a workers' compensation injury. And the other really important thing here is when a serious injury occurs, right at the very beginning, giving some thought to the potential for a common law exposure, so a negligence-based exposure. And also, is there any potential recovery against any third parties that may in fact have contributed to that injury? So here, without wanting to delve into the intricacies of workers' compensation, there's two types of components for benefit structure for injured workers. The first is the statutory cover, which is what we talked about, the no-fault system. They can have been as silly as you like, injured themselves through not following the guidelines, doing something really silly. It's a no-fault system, they're entitled to statutory benefits. If, however, someone suffers a serious injury, they can pursue what's called the common law claim against their employer. In order for a common law claim to be successful, they first have to be assessed as having a whole person impairment that exceeds the benchmarks. So there has to be a significant whole person impairment suffered. And then the second component of pursuing a common law claim is they have to be able to demonstrate that their employer was negligent. Now, as an employer, you have a significant duty of care to your employees. So the benchmark for an employee to reach to prove that you were negligent is not as high as it would be for a complete third party. Because of the pure overarching duty of care that you owe to your employees, but there still has to be a form of negligence. It can't be just, well, I did something really silly, I'd been trained correctly, I'd been inducted correctly, things were labelled properly, I've been told not to do it that way, and I still went ahead and did it. There has to be some form of negligence. And then on the flip side of that, when we talk about recovery potential, with your industries, you're often going to be working on third-party sites. So you're going to be potentially interacting with other contractors, you're going to be working for a principal, you're going to be, on a site where there might be hazards that are outside of your immediate control. So if your employee is injured through someone else's negligence, those sorts of things should be flagged pretty early on in the life of the claim. And the insurer then on your behalf can seek recovery of those costs. And the benefit to that is that it then reduces that claims experience off your record. You're not wearing the entire claims experience. So once we've kind of gone through all of that, what then is the premium rating formula? So we've talked about Gazette rates and starting with the Gazette rate. So where do the Gazette rates have credibility? They have absolute credibility when we're talking about SME businesses. So if you're a small business, you've got, a relatively low wage role and you've got a premium that might be $2,500 or less, your rating is going to be based on the Gazette rate. And the reason for that is because in your actual experience, there's little credibility. You're unlikely to have any kind of frequency of claims because you don't have a significant workforce. But when you have a claim, it's going to cost more than your last 10 years premium put together, most likely. And it would be unfair or unrealistic for insurers to then try to load your premium to such an extent as to recoup the costs of those claims. So for that reason, the credibility given to Gazette rates for SME business is very high. So generally, you're going to be paying on or about the Gazette premium, the Gazette rate. The bigger the business gets, the more significant weighting is given to that own business's policies, procedures, safety management systems, claims experience, and wage roll, trends, growth, reductions, etc. So if you think about a scale from, the $2,000 premium, and by the way, the minimum premium for workers' compensation is about $265, so they do start very small, right the way through to the very biggest of clients that, may be paying around the $2-3 million mark. The clients at the $2 to $3 million end are going to have almost all credibility on their own experience rather than the Gazette rate, whereas the clients at the SME side are going to be charged the Gazette rate. The Gazette has specific rules around it. So for insurers, they're able to load the Gazette rates by up to 75% for poor performing risks. And they can do that without any kind of application to work cover. In addition, they can discount the Gazette rates. And normally that discount caps out, and I say normally, not in all cases, but normally the level of discount caps out at about 50% for good risks. If, for example, you were a medium-sized business and you had a horrific claims experience, so year on year you were having a significant number of losses and a high average claims cost, the insurer may elect to apply to work cover to load your account greater than Gazette plus 75. So it is possible for an insurer to do that, but there's quite a process, a very heavily regulated process for them to go through in order to do that. If they're going through that process, they have to advise you that they're applying to load greater than 75%, and they have to give you, as the employer, the opportunity to dispute that application. So as an employer, you also have an opportunity to present your case to work cover as to why you don't believe you should be loaded by greater than 75%. So the next thing the insurer will do is they'll have a look at your annual average claims cost, and they'll index that to wages. And by that, I mean, if, for example, your business has grown over the last 5 years, so if you had, in very simple terms, 100,000, 200,000, 300,000, 400,000, then 500,000. So you've grown by $100,000 each year. And in each year, you had 1 claim, 2 claims, 3 claims, 4 claims, 5 claims. What the insurer will predict, so they'll index everything. They'll go, well, if next year you've estimated $600,000 worth of wages, you're going to have 6 claims. That's a really simple example, and obviously it never works out quite that straightforward. But effectively, it's highlighting to you that just because 5 years ago you only had 1 claim, if your business has doubled in size in that same time period, the insurer is going to assume that you're going to have double the amount of claims. There's also IBNR factors that are applied to each year's claims cost. Now, this is an insurance term. IBNR simply means incurred but not reported, or incurred but not enough reported. So workers' compensation is called long tail business, and the reason it's called long tail business is because it often will be many years after the actual policy period before the overall claims cost is closed off. So if someone suffers an injury, it may be 12 months, 24 months, in some instances up to 7 years before their claim is actually finalised. For that reason, the insurers apply a loading or a factor, an IBNR factor, to your claims cost. So they'll say at the end of the policy period, you've reported 5 claims for a total cost of $100,000. We expect that there might be another claim still to come in that we don't yet know about, and that $100,000 is in fact going to finish by the time we've paid out everything and closed off each of these claims. That $100,000 might become $150,000. The IBNR factor reduces the older the policy year is, because obviously there has been more time for development to occur, but there is an IBNR factor applied to each year's claims cost. So what's the target loss ratio of insurers? The target loss ratio is 75%. If you go back to my earlier slide and think about the claims cost is 75%, that's why your target loss ratio is 75%. They need to actually have money left over from all the premiums they've collected in order to pay their own costs and generate a return on equity to their shareholders. So if you start with your claims cost plus your IBNR factor at 100 over 75, that gives you your premium. So if you've got a really highly credible individual policy performance, that's the formula that would be used. How does that then become a premium rate? Well, the premium rate is your premium divided by your wages gives you a rate. I've put a little comment there that says don't underestimate wages. There's been, some suggestion in certain areas of the industry that one way to make savings on your workers' compensation cover is to underestimate your wages. So obviously then you've got a lower wage base, by your premium rate, lower premium. Makes perfect sense, except to say it's an adjustable policy. So when you declare your actual wages, you're going to have to declare your actual wages because you're signing a statutory declaration confirming that they're your wages. and that stat dec is auditable. And insurers do audit businesses. But the other reason for not underestimating your wages is it actually results potentially in a higher rate. And by the time you have to declare your actual wages, you've got a higher rate. The rate is not negotiable at that point. So when you're doing your actual wage adjustment, you can't negotiate on your rate. So you're far better to give a realistic estimate of wages right up front for that right figure to be used, and you're getting an appropriate rate for your business. That being said, sometimes things change and you have estimated genuinely that you think you're going to have a 10% growth for the coming year, and then you pick up a big contract or win a piece of new business that you didn't expect to, and that estimate ends up being a little bit out. In the West Australian legislation, there's no penalty for having an estimate that is inaccurate. So there is no, if you're outside of a 10% range, or you've underestimated or overestimated by more than a specific percentage, you're going to get fined. There is in some jurisdictions, but in Western Australia, there is not that component of the legislation. So insurance speak, I guess at the end of the day, I've worked in this industry for over 30 years, as Caroline pointed out at the beginning. Feels like yesterday I started, but there you go. Insurance speak can be confusing. We talk in lots and lots of acronyms. We use terms that are really familiar to us, but don't necessarily mean anything to people outside of our industry. Similar to every industry, I'm sure you guys have exactly the same. Family or friends look at you strangely when you use a specific term, have no idea what you're talking about. So, insurance itself can be complicated, it can be confusing. With workers' compensation, we've only touched today on the factors that can influence your premium. There's also your obligations around contractors. Do you have to include the wages of contractors? Should you exclude the wages of contractors? Just because you call someone a contractor doesn't make them one under the workers' compensation legislation. Just because the tax office treats someone as a contractor doesn't mean they're a contractor under the workers' compensation legislation. So, as usual, nothing is straightforward in our legislative environment. There's often contractual indemnities that you may be asked to sign up for. So you might be doing work for a specific principal and they say, great, we want you to indemnify us for any injury that occurs, and we also want you to waive your rights of subrogation. What does that mean? Can you be insured for that? Should you be insured for that? Should you sign up for it? There's other cover extensions available in Western Australia. So there's common law cover that we touched on briefly. You can increase your common law limit from the standard 50 million to 100 million, or in some instances even up to 200 million. Should you? You can obtain overseas common law cover. You can obtain industrial disease common law cover. So whilst we all think workers' compensation is really straightforward and simple, it's a piece of legislation after all, and cover has to be issued in accordance with that legislation, there are nuances and there are tricky parts of making sure you've met your obligations, you're not opening yourself up to a potential significant uninsured loss by entering into a contractual indemnity. And you should also be provided advice on whether you've obtained the right extensions to cover for your business and for the areas that you're operating in. So appointing and relying on an independent expert, such as an insurance broker, can absolutely save you money and reduce your exposures in these spaces. So what can PSC offer? And this webinar is not about an advertisement, so bear with me for a moment, because other insurance brokers are available and can potentially do some things, but if they're not offering these types of things, please feel free to reach out. So what PSC can offer is specialist claims and injury management services that assist with claims costs. So earlier in the presentation, we talked about what to do when someone injures themselves. We talked about early intervention. We talked about getting people seen by the right medical specialist. We talked about getting an early diagnosis, alternative duties, rehabilitation, all those sorts of things, which, great, really, really simple. But if you've only got to do that once a year or once every 3 years, it's overwhelming and it's a confusing, complicated maze to walk your way through, as well as having to understand the legislation itself. What are your obligations? When do you have to pay someone? When does the claim paperwork have to be submitted? What paperwork has to be submitted? So our workers' compensation or workplace solutions team work in this space day in, day out. It's all they do. So the way that that service operates is an injury occurs, injured employee speaks to their supervisor, supervisor picks up the phone and speaks to a workplace solutions consultant. That consultant talks the supervisor through everything from what paperwork they need to obtain from the injured worker. They can arrange medical appointments, so they can get your worker into a priority appointment with an occupational physician, as we discussed. They can assist with understanding potential light duties that are available or alternative duties that you will have available. They can provide a duty statement for the doctor that is seeing that injured worker to assist them in getting a sign-off to participate in those alternative duties. They will then also assist in writing the return to work plan so that you've got a documented return to work plan so that people on the ground know exactly what that worker can do and what they can't do. They'll follow up further medical appointments, so further medical sign-off and final certificates, of course, which is everybody's aim. If the claim starts to look like it's going off the rails, they can assist in alternative, so external redeployment if it's required. They understand what levers you can use under the legislation to basically, I guess, hold that worker accountable for their own recovery and for their actions. Right the way through to settlement if a claim is a very nasty claim and requires common law settlement. The workplace solutions consultants will also assist with identifying early on in the life of the claim the factors that might make this potential for a common law claim or might make this a possible recovery claim, and they will provide guidance in that space as well. So they step effectively into the shoes of yourself as the employer and assist you throughout that entire process. They also help keep the insurer honest. At the end of the day, the licensed insurers in Western Australia do a really good job, but they have case managers with significant caseloads, significant piles of work on their desk or on their screen now that we all work in an electronic environment. And they don't always or won't necessarily have your claim top of mind. So the role of the workplace solutions consultant includes keeping the insurers on track and keeping them honest and making sure they're doing what they're supposed to be doing as well. So that's the workplace solutions offering, and that is offered to the CCF members as part of the package that PSC offer and deliver to the members. The second part of the PSC role is the insurance broking or the placement, the policy placement side. So that is assisting with gathering the correct information from yourself as the employer and then conducting the premium negotiation on your behalf. So marketing your account to all of the licensed insurers where appropriate to do so, making sure we've given you advice on the extensions and indemnities that we talked about a little bit earlier. So, do you have the right endorsements and extensions on your policy for the activities that you're undertaking? And then we would present to you the options. Now, you can have a conventional policy, which is by far the most common type of policy. A conventional with a claims experience discount. So if you're getting to the, a medium-sized policy, we would negotiate for you to have a claims experience discount, which means if you have a good year performance-wise, you can receive some money back at the end of that policy period, subject to specific parameters. There's also, for larger businesses, options such as deferred payment plan or burning cost programs. So I won't go into those in any detail today. This isn't the right forum for that. But, it's about ensuring that you've got an independent expert that is able to provide appropriate advice for you to structure your workers' compensation policy in the best way possible to make it as cost effective as possible, as well as then also providing that support when and if an injury does occur.